Next is capital structure part 2. Question number 1. Sylvan Corporation has the following capital structure: debenture bonds 10 million, preferred equity 1 million, common equity 39 million. The financial leverage of Sylvan Corporation would increase as a result. Remember, financial leverage increases because of increase in debt. So let us see in which of these options do we have the higher level of debts. Let's see. Issuing common stock, that would increase your equity, and using the proceeds to retire debenture bonds, so that would lower your debt. So this option would rather decrease your leverage, not increase. So this is incorrect. Issuing common stock, that would increase your equity, and using the proceeds to retire preferred stock. So it's simply both are equity elements. So by issuing equity is going up, but when you're retiring your preferred stock, on the other side equity goes down. So there is no change in leverage. We want to see the one that results in increase in leverage. Financing its future investments with higher percentage of bonds. Yes, when the debt goes up, this would cause the increase in financial leverage. That is the right option. Why not D? Financing its future investment with higher percentage of equity funds. Equity would be a larger percentage of your funds deployed, so that would lower your leverage, not increase. So the right option here is C. A firm that designs its cost structure to include a higher degree of operating fixed cost than the variable cost by electing to pay salaries, which is a fixed expense, instead of commissions, which of course is variable dependent upon the level of sales, and it's magnifying the impact of each additional sales dollar using the concept of, since fixed cost is a greater percentage or greater proportion of your total cost, so this would mean that this firm is now using more operating leverage, and that's D, and this is the right option. Next, Carlyle Company presently sells 400,000 bottles of perfume each year. Each bottle costs 0.84 to produce and sells for $1. Fixed costs are $28,000 per year. The firm has annual interest expense of $6,000. Preferred stock dividend is $2,000 per year, and a 40% tax rate is to be used. Carlyle uses the following formula to determine the company's leverage. This is the formula you use to calculate the operating leverage. Then we have for financial, and then the total leverage. And these are further explanations of your formula given. The degree of operating leverage. So if you need to calculate the degree of operating leverage, then what you're talking about? You are talking about the sales quantity, which is given right here, your selling price, which is given right here, and your variable cost, which is given right here, and the third element is fixed cost, which is given right here. Just plug it in and you'll get your answer. So quantity 400,000 units multiplied by the selling price, that is $1, variable cost 0.84 divided by quantity, that is 400,000 units, not dollars, these are the units, and then multiply it with the sales minus variable cost, that is contribution, 1 minus 0.84, and then from this deduct your fixed cost, which is $28,000. If you do all the computation, you will get 1.78, and let's see, that makes A to be the correct option. The following information was taken from Culver Company's financial statements for the current year ending 31st December. We have been given current assets, non-current assets, stockholders' equity, and total operating expenses. We are required to calculate the debt ratio, and this is the formula we use to calculate the debt ratio. Total liabilities, that is current, non-current, divided by the total assets. So use this formula and get your answer. Okay, so what we have been given? We have been given the current assets and non-current assets, that's the total assets, and the stockholders' equity, 10 million. So 25 million and 10 million. We know asset is equal to liabilities plus equity. Since we need to find liabilities, so it's going to be total assets minus equity, 25 minus 10, so that's going to be 15. So total liabilities are 15 million. We need to find the debt ratio, which is equal to total liabilities 15 million divided by total assets, that is 25 million. Just do the computation and you get your answer in percentage. So you would get 60%, and that's going to be probably D. Yes, D. Next. The following information is about three companies, ABC, XYZ and KLM. We have been given the total assets, liabilities and equity. Which company would be considered least risky from a creditor's viewpoint? So what you can do, you can calculate your debt ratio. We've just calculated in the previous question. 44 by 109, and if you do, you'll get 40.37%. Do the same for XYZ, 150 by 450. That will give you 33.33%. Now, do the same for KLM, 450 by 850. That will give you 52.94. So it says that we need to find the one that is least risky. So that is going to be the one with the lowest debt ratio, that is XYZ. XYZ because the debt ratio is the lowest, so this is going to be the least risky from a creditor's viewpoint. So that makes B to be the correct option. And B it is. We have done this question previously, but there we needed to calculate the operating leverage. Here it says Carlyle uses the following formula to determine the company's leverage, but here I think it would be financial leverage that we need to calculate. The degree of financial leverage for Carlyle company. So we have been given the information, just plug it in the numbers and you will get your answer. Okay, now financial leverage requires you to first calculate your EBIT. Okay, so $1 is the selling price and 0.84 is the variable cost, which means the contribution per unit, which you call the unit contribution margin, that is 0.16. How many units are you going to sell? You're going to sell 400,000 units or bottles. This will give you the total contribution, and from that total contribution you just need to deduct your fixed cost, that is $28,000, and this would give you what you call the earning before interest and tax. Your total contribution is 64,000, that is 0.16 times 400,000 bottles, and when you deduct your fixed cost, you get your earning before interest and tax, that is 36,000. So this would be one of the inputs in your financial leverage formula, 36,000 upon 36,000. What is the interest charge or interest expense? It says the interest is given as 6,000. Plug it right here. Then minus preferred stock before tax, just crossing it up by dividing preferred stock with 1 minus tax rate. Preferred stock dividend, that is 2,000 divided by 1 minus tax rate, that is 1 minus 40%. It's a simple arithmetic. If you simplify, you will get your financial leverage to be 1.35. And let's see which of these options has 1.35. If you go down, B is the correct option. Next, which of the following quantitative factors when compared to its industry average could be an indicator of potential corporate failure? High cash flows to total liability, this is something very good. High retained earnings to total assets, again good. Having high retained earning as a proportion of total asset is something to be proud of. High fixed cost to total cost structure, that is what give rise to operating leverage, and this is what could result in corporate failure. That's what could cause trouble. High fixed assets to non-current liabilities, great. You have less leverage, that is good. But this is the cause of concern that could result into corporate failure. A company has income after tax of 5.4 million, interest expense of 1 million for the year, depreciation expense of 1 million, and a 40% tax rate. What is the company's times interest earned ratio, or sometimes called the interest coverage ratio? So we can just write down the formula and plug in the numbers. Times interest earned, or I would love to call it interest coverage. It is equal to earning before interest and tax divided by the interest expense. We don't have it. We don't have EBIT, so you can work it back. We have net income, which is $5.4 million. By dividing your net income with 1 minus tax rate, which happens to be 40%, we'll gross this amount up and convert it into pre-tax income, and that's going to be 5.4 upon 0.60. That'll give you $9 million. This is your earning before tax, not EBIT. Add your interest expense back, and that will give you, this is the interest expense, this then will give you EBIT, and that's what we need, 10 million. Now, Your EBIT is 10 million. Your interest expense is 1 million. So it's 10 times. You have significant earnings sufficient enough to pay your interest expense 10 times, even just you have to pay it once. So that makes C to be the correct option. Alright, next question. Southern Corporation has debt to equity ratio of 1.75 and total assets of 275 million. Southern is considering issuing another 20 million of debt, another 20 million of equity. What will be Southern's debt to equity ratio after the issuance? So the first step you need to do in this question is to find first what is the debt total figure and the equity. And this can be done by just using this formula. Debt upon equity is equal to 1.75 and total assets are given, which means we know debt plus equity is equal to total assets. That is 275. Now, from this equation, debt is equal to 1.75 times of equity. We can use these two equations simultaneously. Replace D with 1.75. 1.75 times of equity plus equity is equal to 275, which means 2.75 times equity is equal to 275, and that implies equity is equal to 100. If equity is 100, debt is 1.75 times of it, that means 175. Now we know this is the level of our current debt, 175 million. This is the level of equity. Now if they both go up by 20 million, so the new ratio is going to be 195, that is 175 plus 20, and 120, that is 100 plus 20. So when you do 195 by 120, it gives you 1.625. 1.625, which is approximately 1.63, and that's your option C. Next, we have done this question before, but this time we need to find something else. It says if Carlyle Company did not have preferred stock, the degree of total leverage would increase, decrease in proportion to financial leverage. Let's see. These are the formulas here. Now look at this. If there was no preferred stock, you won't have this in this denominator of financial leverage and in the total leverage, right? So it means financial leverage and total leverage, they will both fall by same proportion, right? So the option that we should look for is that they will both decrease proportionally. If Carlyle Company didn't have preferred stock, the degree of total leverage would decrease in proportion to decrease in financial leverage. That makes B to be the correct option. Our company currently has 1,000 shares of common stock outstanding with zero debt. It has the choice of raising an additional $100,000 by issuing 9% long-term debt, first option, or issuing 500 shares of common stock. The company has 40% tax rate. What level of earnings before interest and taxes would result in the same earnings per share for two financing options? So we have been given EBIT to start from. So let us do for each level of EBIT 10,800, 27 and 18,000. So let's start first with the level A, 10,800. Equity, debt. So we have been given EBIT 10,800 in the first option. Let us first pay interest. So interest is going to be nil here, but in this case it's going to be 9% of 100,000 is going to be 9,000. So after the payment of interest, in this case you will have 1,800. Here you will have the full amount, 10,800. Now this is the earning before tax. Now pay tax. Tax at the rate of 40% for 10,800 is going to be 4,320. And the rate of 40% for 1,800 is going to be 720. Now we have the earning after interest and tax, that is your net income. And for the case of all equity, it's going to be 6,480. And in this case, it's going to be 1,080. Now, if you divide 6,480 with 1,500 shares, because in equity issue we will have 1,000 shares existing and 500 issued now, so there will be a division by 1,500 in order to calculate your EPS. And if you do, you're going to get 4.32. And in case of debt, it's going to be 1,080 upon 1,000. Remember, in this case, is going to be thousand, so it's going to be 1.08. So that makes option A to be invalid. It says that it will result in EPS of 7.92 in both cases. No, 4.32 in case of equity issue and 1.08 in case of debt. Let us check these for BCD. It's a good question for practice purpose. Now trying the second option where EBIT is 27,000. Since in option E, when we issue equity, there is no interest, so interest is nil. But in case of debt issue, interest is going to be 9,000. So this is earning before tax and of course after interest. Tax at the rate of 40%, 10,800, 7,200. And when you calculate net income for equity issue, it's going to be 16,200, and for here 10,800. Now remember, for equity issue there are going to be a total of 1,500 shares, which we will use as a denominator to find EPS. 16,200 upon 1,500, 10.8. And here, since in debt issue our number of shares remains same, 1,000, so it's going to be 10,800 upon 1,000, 10.8. So this is not the option B. Clearly what we get is the right option is option C. EBIT of 27,000 would result in EPS of 10.8 for both, and that is the evidence. So that makes C to be the correct option. Next, a company has total cost of $100,000, of which 40% is variable, and that would mean 60% is fixed. So it means that out of the total cost, $40,000 represents the variable cost and $60,000 represents the fixed cost. What is the operating leverage? Operating leverage can be expressed as fixed cost is what proportion of variable cost. So fixed cost is 60,000, variable cost is 40. So if you simplify, it's going to be 1.5, and that is going to be C. That completes your questions in this section, Capital Structure Part 2.